at reducing our electricity consumption. Over the last 3 years, we've dropped our consumption by 14%. And 14% in our terms translates to around about 70 megawatts. Now you can run 200,000 ounce a year operations in West Africa for what we've saved. That's just to give you an indication of the magnitude. And the other thing is we're just looking at a range of initiatives right through the value chain. How do we stamp out inefficiencies, wastage? Let's go and do reclamation of old equipment underground before we requisition the purchases of new equipment. And it's just thinking smarter about the entire value chain between the stope face and the plant. And it's no one silver bullet. It's a whole range of initiatives that we're putting in place to achieve what we've done.
You mentioned strike action and the kind of impact it's had on cost. Let's take a look at the impact it's had on production, because production levels coming in line with guidance. Are you on target or in line with hitting your target for full year production as we progress forward?
Absolutely. As we've indicated in our quarterly book today, we're sticking with our guidance for the entire year that we set out at the beginning of this year. So we still believe we're going to hit that. And we're going to be within the NCE guidance as well, the all-in cost of producing an ounce. So I'm very pleased with the big effort that the team have put into to make sure that we can deliver those goals.
At your last set of earnings, I mean, you mentioned the possibility of mining below infrastructure. That was at least talked about, but you were asking, is it better to be spending capital at 3.5 to 4 kilometers underground, or is it better to deploy that money into a new open pit operation surface elsewhere? Has your stance on that front changed? And I ask the question because just this morning, AngloGold Ashanti announced that it could employ deep mining technology to pursue mining activity at deeper levels.
Well, look, the good news for Goldfields is we don't have to go deeper at this point in time. We've got significant reserves already, what we call above infrastructure, which is above 4 kilometers. We have 20 million ounces at the KDC complex. But more importantly, we have 35 million ounces at South Deep. So we've got more than enough to keep us busy down to 3.5 kilometers already. So we don't really need to think beyond that at this stage. We've got more than enough to keep us busy above infrastructure. The other thing that is quite important is with the Rand gold price having increased to about 450,000 Rand a kilogram, we are re-evaluating all of our surface resources. And if we look at our total surface resources of gold, in the form of tails dams and rock dumps and the like, we've got an inventory which is at a resource category of over 4.6 million ounces of gold on surface. And the big focus now is how do we accelerate the processing of all of that gold? How do we utilize all of our processing capacity on surface? How do we look at bringing in incremental processing capacity? Because that's already been mined. And all you've got to do is now pump it and process it at your incremental cost or your marginal cost. And at these sort of prices, that provides a tremendous opportunity to add value.
Well, just yesterday, South Africa's credit rating outlook was downgraded by Moody's. Moody's changed Goldfields' Baa3 credit rating outlook to positive from stable. And the reason there was because you're diversifying your production and becoming less dependent on South Africa. Of course, the downgrade that came through on the South African front regarding nationalisation and the kind of rhetoric and politicking that's been going around. What's your thoughts on the risk scenario in South Africa?
I don't think nationalisation is a viable outcome for the economy. And when I look at the statements that have been made by government to the same effect over the last few months, I think it validates that it's not the best outcome. By the same token, I think we all recognise that there's a significant gap in income groups, and we've got to find some way collectively as a country to try and address the plight, particularly of the youth who are coming through and are wondering about their future. And I've indicated at a number of forums that Goldfields in particular is keen to see how we can help address skills gaps, youth development programs, and if we can work together with government and create a public-private partnership that really takes this forward, I think that is the way to tackle this issue. I think to get involved in rhetoric about nationalisation is good or nationalisation is bad, I don't think that's helpful to anyone. What's far more important is how do we address some of the social imbalances that exist in the country in a way that's going to be sustainable for the mining industry.
While you are doing that, I mean, 50% of your exposure to South Africa, 50% to international operations, are you looking at reducing your South African exposure any further?
Well, we've said all along a strategy that I put in place when I got into office 3.5 years ago was that ultimately I was looking for about 5 million ounces of production and about 40% of that coming from outside of South Africa. When I started in the job, we had two-thirds of our production coming from inside of South Africa. So that's where we want to move to. But that isn't to say that we are not committed to South Africa. We're building South Deep. $1 billion is going to be spent on South Deep over the next 4 to 5 years, which is undoubtedly going to be the longest standing mine in South Africa. It'll be mining for the next 60, 70 years, without doubt. And unlike any of the other mines in the country at this stage, or possibly in the future, it's going to be a fully mechanized mine, and is already. It's not as if we have to get there, we're already doing it and we're ramping up. So we need to get the right geographical balance, but at the same time, we're going to be growing the company off a proud South African base.